Welcome to the Gamma Brief. It is Tuesday, August 18th at 6:45 a.m. Eastern. If you're new here, the Gamma Brief is an experiment. I'm using a layered generative AI pipeline to capture market data, economic events, and structural mechanics, and then turn all of that into accurate, actionable briefings every morning. This brief calculates all those levels from a single data source, the SPX 0 DTE options chain. As always, this is market intelligence, not financial advice. All right, let's get into it. ES futures are trading at 7,732. Yesterday's mixed forecast missed the mark when Iran-related headline risks shattered the 7,775 put wall, dragging the close down to 7,745. If the overnight gap holds into the open, the new structural floor will be tested immediately. If it breaks, the descent path is entirely unhedged. The regime has flipped decisively to negative gamma, carrying a net VIX magnitude of negative $1.7 billion. There is no flip within the observable chain. Dealers are now universally short options, meaning their hedging flow mandates buying into rallies and selling into declines. With the VIX pushing higher to 15.94, this procyclical posture means dealer mechanics will amplify intraday swings rather than dampen them. Without a structural flip to force mean reversion, this is a type wired for momentum. Looking at the geometry, ES sits 7 above the put wall at 7,725 and 68 from the call wall at 7,800. The expected move band spans plus or minus 78 points from the prior cash close, setting the lower bound at 7,667 and the upper at 7,823. Because the overnight gap has already pushed ES to the brink of the 7,725 put wall, that structural support is under immediate threat. A breach there leaves a massive void before the lower expected move boundary. Overnight equity markets priced in acute geopolitical risk as fading US-Iran ceasefire hopes sent oil higher. Across assets, ES futures slid 0.47%, VIX expanded nearly 5%, and the 10-year yield climbed 4 basis points to pressure the complex. Sector flow reflects this defensive posture, with industrials up 1.1% and healthcare adding 0.9%, while communication services and financials lag heavily, dropping 2.1% and 0.9% respectively. On the risk radar, the pre-market is clear, meaning current conditions carry directly into the bell. Intraday, the calendar brings import and export prices at 8:30 a.m. Eastern, industrial production at 9:15, and pending home sales at 10. In a negative gamma environment, any hot inflation print or macro shock that drives price through the put wall will trigger aggressive dealer selling, creating asymmetric downside risk. The environment is consistent with defined risk directional setups that capitalize on momentum. Short premium in this regime is selling insurance while the building is already on fire. Defined risk directional structures are built for this environment. The primary plan triggers on a break below the 7,725 put wall, aiming for lower support levels. A sustained reclaim above 7,775 invalidates the downside read and opens the door for a dealer-fueled chase toward the 7,800 call wall. Dealers are positioned to amplify price action across the entire board. A break of the 7,725 put wall converts structural support into a momentum trapdoor. Yesterday's read didn't hold. Respect the levels, not the narrative. Level set, buys defined. Good luck out there. Standard disclaimer remains. Gamma Brief and Gex Log are market intelligence, not financial advice. Options are high risk. Manage your size and trade your own plan.